Hello, welcome to our discussion on transfer pricing models. This is an audio recording to discuss transfer pricing and the different models of transfer pricing that are used in transfer pricing activities. Allocating costs to a responsibility center or segment involves assigning pricing for the goods and services that pass between segments. Transfer pricing sets prices for internally exchanged goods and services. An intermediate product is a good or service that is transferred between two segments of a company. Company strategy is greatly affected by choice of transfer prices. If the company wants the business units to behave independently and keep managers motivated to achieve company goals, transfer prices should be set at arm's length, as if the party were any other external client. When no external suppliers or customers exist for a product or service, the arm's length price, an impartial or fair market price, is more difficult to determine than simply checking market prices. The amounts set for transfer prices require cooperation between many departments, including finance, production, marketing, and tax planning. Firms that have a high degree of vertical integration will need to carefully set transfer prices. For example, a corporation that owns farms, food warehouses, distributors, and grocery stores will need to set prices for each service that will be considered fair by all segments, and also allow each portion of their business to be financially flexible. Four models that can be used to set transfer prices are market price, negotiated price, variable cost, and full cost. Firms often combine various methods, called dual pricing, to match their needs. The market price model is a true arm's length model because it sets the price for a good or service at going market prices. This model can be used only when an item has a market. Items such as work-in-process inventory may not have a market price. The market price model keeps business units autonomous, forces the selling unit to be competitive with external suppliers, and is preferred by tax authorities. Businesses that use this model should account for the reduced selling and marketing costs in the price. The negotiated price model sets the transfer price through negotiation between the buyer and the seller. When different business units experience conflicts, negotiation or even arbitration may be needed to keep the company as a whole functioning efficiently. Negotiated prices can make both buying and selling units less autonomous. The variable cost model sets transfer prices at the unit's variable cost, or the actual cost to produce the good or service, less all fixed costs. This method will lower the selling unit's profits and increase the buying unit's profits due to the low price. This model is advantageous for selling units that have excess capacity or for situations when a buying unit could purchase from external sources but the company wants to encourage internal purchases. Among the disadvantages of this method is the fact that it is not viewed favorably by tax authorities because it lowers the profits and thereby taxes for the allocation for the where the product was manufactured. The full cost or absorption model starts with the seller's variable cost for the item and then allocates fixed costs to the price. Some companies allocate standard fixed costs because this allows the buying unit to know the cost in advance and keeps the seller from becoming too inefficient due to a captive buyer that pays for the inefficiencies. Adding fixed costs is relatively straightforward and fair. However, it can alter a business unit's decision making. Although fixed costs should not be included in the decision to purchase items internally or externally, often managers will purchase the lower cost external item even though the internal fixed costs will still be incurred. In choosing transfer price models, in general, the market price method is preferred, especially in situations when the market price for a good or service is available. When a market price is not available, the negotiated price method is preferred. When neither is acceptable, companies may turn to one of the cost models. Cost-based methods are not recommended because they can lead to motivation problems between parties, such as the seller not actively controlling costs because they are simply passed on to the buyer. The logic of choosing a transfer price model and setting transfer prices starts with a make or buy decision. If there are outside suppliers for a product or service, then the market price model should be used. The company should compare the selling unit's variable costs to the market price for the external substitute. If the external market price is lower than the internal variable cost, the buyer should purchase externally to motivate the internal supplier to find ways to lower costs. When the internal variable cost is less than the external market price, then the buying unit should purchase internally as long as the selling unit has excess capacity. The variable cost model is best for low capacity, and the market price model is best for high capacity. If the selling unit is at full capacity, the buying unit should purchase externally as long as the selling unit can generate more profit from a sale to an external source than will be lost if the buying unit pays the external market price for the item. When the opposite is true, the buying unit should purchase internally and pay market price for the item.